Welcome to the Shakaama Live Show with your host, Shakaama. First, in this series, we're going to make a couple of definitions so that we know that everybody is on the same page. This series is about credit. Be sure to click that thumbs up button. And if you need to leave a comment, ask questions, this will be interactive. That's what the series is about. Me talking to you and you asking questions back. First, we're going to start out with what is credit? Credit is a broad term that has many different meanings in the financial world. It is generally defined as a contractual agreement in which a borrower, that means you, receives something of value now and agrees to repay the lender at a later date, generally with interest. Sometimes it may even involve crediting a 401k, for instance. Credit also refers to the creditworthiness or credit history of an individual, that means you, or company. It also refers to an accounting entry that either decreases assets or increases liabilities and equity on a company's balance sheet. If you need for me to go into talking about balance sheets and accounting, I will do that. In the first and most common definition of the term, credit refers to an agreement to purchase a good or a service with the express promise to pay for it later. This is known as buying on credit. The most common form of buying on credit is with credit cards, which is what we're talking about. People tend to make purchases with credit cards because they may not have enough cash on hand to make the purchase. Accepting credit cards can help increase sales at retailers or between businesses. The amount of money a consumer or business has available to borrow, or their creditworthiness, is also called credit. For example, someone may say he has great credit, so he's not worried about the bank rejecting his mortgage application. In other words, credit refers to a deduction in the amount of he owes. For example, imagine someone owes his credit card company $1,000, but he returns a purchase worth $300 to the store. He receives a credit on his account and then owes only $700. Now here's an importance. Service credit is an agreement between a consumer and a service provider, such as a utility, cell phone, or cable service. Finally, credit is an entry that depicts in accounting to increase asset or decrease liability. So a credit increases net income on the company's income statement, while debit reduces net income. We can go over that also if you so want me to. So there are many types of credit. The most popular form is bank or financial credit. This includes car loans, mortgages, signature loans, and lines of credit. Essentially, when the bank lends to a consumer, it credits money to the borrower who must pay it back at a future date. For example, when someone makes use of his Visa card to make a purchase, the card is considered a form of credit because he is buying goods with the understanding he will pay the bank back later. Financial resources is not the only form of credit that may be offered. There may be an exchange of goods and services in exchange for a deferred payment. When suppliers give products or services to an individual but don't require payment until later, that is a form of credit. So when a restaurant receives truckloads of food from a vendor who doesn't demand payment until a month later, the vendor is offering the restaurant a form of credit. So here are some hot takes on this. Credit is generally defined as an agreement between a lender and a borrower who promises to pay the lender at a later date, generally with interest. A credit is also refers to an individual or a business creditworthiness or credit history. In accounting, a credit may either decrease assets or increase liabilities and equity on a company's balance sheet. This is the first definition of credit, I'm going to do another definition of credit just to make sure that everybody understands and that we have a basis to continue on with the discussion and nobody's left behind. Thank you all for watching. Be sure to watch the entire series. Thank you.